Welcome back to our conversation with Gordon Malin as we're talking about the InsureSec industry and how it's evolving and impacting us all. You have an insurance company, right? So you have a carrier. They offer a certain amount of, and they can offer so much because they only have so much capital that can back that type of
Correct.
projected losses. And then about 150, 200 years ago, there was a concept of reinsurance where another insurance company says, hey, I'm going to take part of that risk away from you and share the risk at a broader scale. And they help to create supply up here and saying, oh, I think we can create more supply for you, insurance company, if we spread your risk out over this type of a portfolio. We'll think in portfolios here in the reinsurance, and you have individual insureds that you worry about, and maybe you have a portfolio of those, but they're individuals, and all of a sudden you get this portfolio at the reinsurance, and then they help create capital, suck it in, and say it's worth the risk, bring it on in from Wall Street or whoever else. Is that sort of how that ecosystem works?
That's exactly how it works.
Ah,
And the and
wow.
the and the cyber and it's a way for an insurance carrier to essentially diversify or manage their exposure. So in reinsurance, we have there's basically two major forms of reinsurance. One is called quota share. That is you're straight sharing. Let's say it's a 50% quota share for simplicity. You're giving the reinsurer 50% of the
Yeah,
premium, and they're going to
yeah,
cover 50% of the losses. Then there's what's called XOL, or excess of loss. And that is essentially the reinsurer is saying you are allowed to have, or essentially you're saying the insured basically will absorb losses up to X.
yep,
And then above X, the reinsurer will step in and cover the
yeah,
rest of those,
yeah,
right? So excess of loss. Those are the
yeah.
two main forms. In cyber, quota share is probably the most prevalent. And typically, as an insurance company, typically what you do when you're growing a new line of business, you utilize quota share reinsurance from the very beginning because you're not quite sure how it's going to play out, and you want someone else kind of sitting there absorbing some of that risk with you. Truly, the reinsurers are your partner in that, right? And that's how that relationship works. As you grow, you get more comfort in the numbers, you get more comfort in kind of the projections and how this looks. You tend to kind of cut back your quota share, and you use less and less of it. You pretty much will always use some because it's just good risk management to always be able to have access to reinsurance capacity as you want to grow your portfolio. And then you will layer on excess of loss as well. So you can really kind of manage your risk tolerance. You can manage your PML. So that is fundamentally how it works.
So InsureSec itself is a mindset of sorts. It's an approach in terms of saying, look, if we can put together good cyber hygiene or some kind of a hygiene that makes you more resilient or not so exposed, and mesh that with the cyber policy, one, for you as the insurer, it reduces your risk and improves your profitability and allows you to give probably some very aggressive rates or at least some more predictability in those relationships. And I would suspect because you're putting this together, it may be in a very attractive way that you could address the small mid-sized businesses. Is that sort of who's attracted to this kind of an approach more than an enterprise because they have a lot of people? And
100%. Yeah. So InsureSec is really focused on, I would say, the small and middle, right? Large accounts, they have a CISO, they have a team, they have a
yeah,
budget, they have a lot of resources, and they have spent a lot of money on security, right?
yeah,
And then they have an insurance policy that basically is that kind of catch-all where if they do have an incident, they at least have, a financial recovery to be able to lean on. But they're managing their security stack themselves. That's why you have a CISO and a team. When you get down to the middle market, you have MSSPs who kind of function
hmm hmm
as that kind of outsourced CISO, if you will. And many middle market companies have a CISO or a CIO who acts like one. And then when you get down into the small businesses, they don't have they have outsourced IT. They don't have anyone doing security for them. They have no one in-house who really even knows how to spell MFA. Now they do. A few years ago, they didn't.
yeah,
And so really when you start to kind of, I would say, amalgamate the security product into the insurance product, then you're able to deliver a complete package to
Yeah.
that small business. And fundamentally, then what you become is they're kind of their single stop shop for all of their cybersecurity needs. Insurance is just another tool, right? Insurance is a
Yeah.
tool that sits there when the MFA doesn't work, when the backups don't work, when the email security doesn't work, when the EDR doesn't catch it. Well, then you have insurance to rely on. So it's really another tool. And really, we think of it as like it's kind of two sides of the same coin, but security and insurance have never really spoken to each other, right?
Yeah.
And what
Right.
we're doing, and what, to your point, the InsureSec, community is doing, is really bringing those two together into a more integrated, fulsome package. Everyone has their different strategies on how they're doing it,
Yeah.
but really that's what's going on. So think about it, right? Going back to PML management, right? We know down to the endpoint our exposure to every single software application that's in
Yeah.
our portfolio, every single cloud provider, what region they're in. We know it down to, who uses Salesforce, who uses HubSpot, who uses Zoom, who uses WebEx. So when you get those 0-day exploits, you're able to triage them at scale rapidly and close the doors before the threat actors could take advantage of that vulnerability. So going back to your earlier question, really what we're doing is we are creating supply because we're reducing PML
Yeah.
because of our
Okay.
ability to not only identify vulnerabilities. So a traditional insurance carrier, they write a policy, they're on risk for a year. They have no idea what's going on with the security posture of that organization. They have an application that they got at the beginning of the policy, which is they bound and issued it. And then they literally get zero visibility until the next renewal a year later. There is some capabilities now that early days, a few years ago, the external scanning became very popular because it gave a
Mhm.
way for
Okay.
insurance carriers to kind of see the attack surface the same way that threat actors would. And so you'd
Right.
see, things, open ports, things that you could actually close down and impact lost content. And that became a thing for a while. Now we're stepping beyond external scanning and moving towards what the insurance industry affectionately calls inside out, right? Think about EDRs, right? They're in the box, they're on the box. We're able to essentially get telemetry. We'll be able to actually impact the security posture of the organization. We'll be able to reduce their attack surface in real time
Yeah.
while on risk, right? We kind of like to say like we're on risk, but we're also in the risk. And that enables us to affect change throughout the life of the policy, ensure that our portfolio is constantly as healthy as it can be. So a new KEV comes out. And for those listening who don't
Yeah.
know what that is, CVEs, common vulnerabilities and exploits. CISA puts out there's a massive list of those, and
Yeah.
it's updated on a pretty much, I think, daily basis. And there's,
Yeah.
I don't know,
You can get
30,000 of them.
alerts and everything is sent from
You get
CISA,
alerts
right?
on them.
Yeah. Yeah.
Those are the vulnerabilities that are exploitable in software that we all use. KEVs are the known exploited vulnerabilities that that CISA knows are actually being utilized in the wild by threat actors as we speak. So
Yeah.
we do I'll say it, we do a phenomenal job closing KEVs, right? We focus on those. We
Yeah.
focus on a lot of things, but anytime there's a KEV in our portfolio, we send out an alert. We help the
Yeah.
insured close that gap and essentially eradicate that exposure from our portfolio. When you're able to do that at scale, that
Yeah.
enables you to really not only bend your attritional loss curve, but it also enables you to bend your PML.
So as this evolves, you brought two worlds together, insurance and cyber, yeah, or security. Yeah. So you brought the two worlds together within an organization. It sounds like it could scale outwards into other parts of the organization to really start to look at a higher plane of risk management at a higher level. Do you see it evolving into that type of an
So
approach?
the way I think this evolves is I think the cyber insurance product and the insurance distribution chain will actually be a distribution chain that will be utilized to get cybersecurity software hygiene into businesses, small and mid-sized. I don't think
Yeah.
large are still gonna, buy the
Yep.
way they always have. I
Yep.
think small businesses will begin to essentially procure their cybersecurity controls through the insurance policy, through the insurance ecosystem,
Yeah.
because they're getting an economic benefit, to your point earlier, from the policy, right? If they're buying with the policy, they're installing an EDR, they're installing email security. Well, they're a better risk. So you're going to give them a better price. You're going to give them more coverage because you know they're a better risk. And if you're also going to give them if you're also going to give them the security product that they need at
Yeah.
potentially a bundled price, they don't need to go buy that same security product at a much higher price from an external third-party vendor who's charging a margin on it. So fundamentally, there's a lower acquisition cost
Yeah.
for cybersecurity product through the insurance distribution channel.
Do you see possibly that, all of a sudden you see technology companies and insurance companies merging together and offering some kind of a hybrid, or is that just a little too far-fetched?
No, so I don't think you're going to see security companies and insurance companies merge. Zero chance of that. That's not
Yeah.
that won't happen. They're just fundamentally different investors, different
Yeah.
valuation regimes. That's not going to happen. But
Okay.
absolutely, very much, I could see partnerships with leading security
Yeah.
product as
Yeah.
well as leading insurance carriers putting together and this is
Mhm.
already beginning to happen, putting
Yeah.
together a more bundled solution
Yeah.
that is advantageous to the end consumer, which is ultimately what we're trying to do, right?
Yeah.
Like more advantageous to the consumer by giving them, again, better terms, better product, the security that they need. And it's actually, I think it's going to very quickly, the little old insurance ecosystem is going to inform cybersecurity spend as we move forward, because you're going to get better rates and terms based on your security stack, right? If you're using, top of the line commercial grade security product versus nothing, never mind, someone that is, mediocre in terms of, security capabilities, the insurance carriers are going to identify that really quickly because they're going to realize they're going to start getting more claims from those that A, aren't using product, or B, are using subpar product. And they're going to
Yeah.
realize that the loss profile of people that are using, high quality product is significant. So
Mhm.
they're going to start
Yeah.
pushing people either directly or indirectly into the leading security providers because they're going to be able to essentially
Yeah.
the a la carte price is going to be, well, let me rephrase that. Essentially the bundled price of that is going to be materially economically benefit, budget benefit for the
Yeah.
business. They're going to save money by getting their security products through the insurance channel.
Interesting. You could almost, the underwriters could start to identify the value that the products bring to the table, or the solutions that
Absolutely.
bring to the table, and then dictate those. This is what your value is in my world. So that would be an interesting dynamic I hadn't thought of.
No,
Yeah.
think about it, right? Like we have the capabilities, we have the data, the claims data to
Right.
be able to, as an industry, to be able to say, well, which EDR providers
Yeah.
stop more loss than others? Which email security providers
Yeah.
stop more loss than others, right? You keep kind of going down that list, and all of a sudden you realize, well, all right, this security product is massively better at reducing losses for us than this one. Like, we're not going to underwrite anyone that has this product because we know it doesn't work as well as this one. But if they have this one, we're going to give them a better price and better terms, right? So,
Yeah. Yeah.
like, it's almost like the insurance ecosystem are the ones grading the exams of the security companies.
It's the future market maker. I mean, they're the new marketplace. Effectively, it could be the technology marketplace and saying, "Hey, we need to, we need this. We need to reduce our curve by this much, and these three qualify. Let's them compete for our business now." Something like that. Is that correct?
Yeah, and if you think about it, the insurance carriers are the ones with the most motivation to ensure that people have good posture because they're the ones that are literally economically aligned with the insured, right?
Yeah.
If the insured has a claim, they're the ones paying up for it. So
Yeah.
they're the ones
Yeah.
that care that they're protected the most. So the insurance carriers are the ones we're going to be the ones that are identifying which security product companies should have and utilize because we will give them better price and terms. So you will actually begin to shape the market share
Yeah.
of security companies because of their efficacy. And you think about it, right? You have a security product. I'm sure you have a ton of them. You use
Yeah.
them. You have an incident. Does your security company care if you have an incident? No, they're not. They're not. I mean, they might be like, "I'm sorry, we didn't
Yeah.
catch that one. We're 99.9% effective. Sorry, you're that
Yeah.
last, that last data point."
Oops.
But
Oops.
they don't. It doesn't matter for their bottom line.
Yeah.
The insurance company cares. They're the ones that care because they're the ones paying the claim. And insurance companies, we expect to pay claims. We're going to pay claims. We just want to pay less of them than we have to, right? So I think you'll see a evolution over the next few years where more and more so insurance companies are bizarrely dictating security software spend.
Well, it's interesting because the InsureSec is like a speedboat versus a ship that's like an aircraft carrier that's slower to move, because historically the insurance industry is very conservative, right? But now it sounds like with this the bent of cyber insurance, it could actually lead technology innovation that hasn't happened before and become kind of a thought leader and a market dynamic that hasn't existed before. Is that possible?
Absolutely. Absolutely.
Interesting.
Yeah, no, it's and I'll give you another concept that I think is, well, another thought here is market share. So security companies, obviously,
Yeah.
some of them have significant market share. From an insurance perspective, that's bad because insurance is all about diversification. You don't want to have all your risk with any one cloud provider, with any
Yeah.
one, software provider, with any one security provider, right?
Yeah.
So we're gonna force distribution and diversification of security product, even
Yeah.
within that category, right? So there's going to be a number of winners in email, in EDR, X, Y, and Z security category, because you need diversification, because any one of those can be a single point of failure. And that notion of single point of failure is what the insurance world is terrified of, right? What really, we go back to the hard market in insurance in 2021. A lot of it is attributed to the ransomware epidemic, which is true. They were causing a lot of attritional loss, but really what scared the heck out of the insurance world, what scared the heck out of C-suites and boards, was the fact that you had three systemic events happen in December. I think it was SolarWinds, then you had Kaseya, and then you had Microsoft Exchange back to back to back. And people are looking at their portfolio going, "Oh my God, I have 40% of my portfolio exposed to this single incident," right?
Yeah.
And so, fast forward to this year, you had Change Healthcare, which massively impacted the healthcare industry. You had CDK, which 75% of auto dealers use. We had CrowdStrike, which fortunately
I was
turned
going to
out.
say CrowdStrike was a perfect example.
I'm glad you said it.
Yeah.
In the live version of this, you're going to be the one that says CrowdStrike, not me.
Absolutely. But you know what? I saw but Gordon, I saw the CrowdStrike guys in various meetings, and they handled themselves with, they were really, they handled it very well, I think, in terms of, to give them kudos, honestly.
100%. The outcome could have been far worse. And that morning, that Friday morning or Thursday night, wherever you were when that happened, the insurance world was freaked out because they're looking at their portfolio, and the market share there, going back to my earlier comment, was very large. And so you had the entire cyber insurance ecosystem that Friday and that weekend was in pure panic mode.
Yeah.
But, to your point, absolutely. The fact that you got an update out there very quickly, people were kind of able to patch through the blue screen and, reboot and get back up and running quickly. Like that actually resulted in there was still some insured loss, but it was not as bad as it could have been. It was a gentle, friendly reminder. It was a unfriendly reminder that these single points of failure exist. And from an insurance perspective, we need to manage single points of failure, right? So going back to what I was talking about earlier, being able to understand the single points of failure you have in your portfolio, and that's really where it comes down to. So like we've been preaching MDR since the dawn of Elpha's existence, because the EDR is the way to get the telemetry to really understand your exposure from a single point of failure perspective, right? So we think EDR is probably one of the most powerful tools from an
Yeah.
insurance perspective. It's one of the most powerful tools from a straight up security perspective
Yeah.
as well.
Yeah.
But from an insurance perspective, it's extraordinarily powerful for that
Yeah.
reason. So that enables people to have a better sense of their portfolio at a granular level.
Yeah.
And then you'll be able to layer that over the models, right? We have catastrophe models for cyber now. CyberQ, one of the leading modeling companies, they tell insurance carriers all day long what their PMLs are, right?
Yeah.
And that's a constant, that'll be a constantly evolving, it'll be a constantly evolving product. But the cyber catastrophe models today, a lot of what they're doing is it's educated guesswork, but it's a lot of assumptions being based on triangulating data, expert opinion, and as much as literally they're doing the best job they can. But if you're able to actually have the real data from your portfolio, that's very, very powerful and helps you manage PMLs better than anyone else, quite frankly.
So it sounds like we're starting to, going back to your Nature's Casino, we started the conversation with, there are lessons that have been taken from there that are being applied to date, sounds like, in some way or form.
Yes, we have seen this movie before. And that's and from an insurance perspective, we've seen this movie before, which is why it's kind of easy to write the ending, because we've already seen how this plays out. We've just seen it in property. Cyber, because we already know how this is going to work, is going to happen much faster. And that's why you're actually seeing cyber catastrophe bonds being sold into the market. Some of the leading cyber insurance carriers are issuing cyber cat bonds as we speak to investors to essentially protect them against that very large single point of failure, that very large aggregation loss. They're starting to tap into the capital markets because they've done that same supply demand math and look out a few years and realize that the traditional reinsurance market doesn't have the capacity to solve for their tail risk needs as we move forward and as this product continues to evolve and grow, right? As I said, we're 16, 17 billion probably right now on a global premium base, somewhere in that order of magnitude. Most people pontificate that this is a $50 billion line of business at some point, 30, 50, 75. I've heard all sorts of estimates, and yes, they're all right. I don't know. It will be materially larger than we are right now. But the only way we get there is if we free up supply of capacity. And that is done only if we really integrate with security software to be able to have better visibility on PMLs.
So let's keep an eye out for the audience, single points of failure. Think about that number, to help prevent some systemic losses, like your cloud usage. Maybe you want to have two different clouds going at the same time. Possibly stuff like that. This is an quickly evolving dynamic that's happening, Gordon, it sounds like, and it's going to continue down this path. I don't see it changing, especially for small, mid-sized businesses, which is really the dominant share of who listens to our podcast. So any final thoughts before I ask you the question of the one thing? Any final thoughts? And then I'll ask you the one thing.
Final thoughts. It's a great question. I have a lot of thoughts. No, but I would just say, if you're listening and you don't have cyber insurance, go buy it. You will be thankful one day. I don't know when, but you will be, I promise. Buy it from us if you want to, but just buy it from someone. I don't care who. Go buy it. And I would say, get the most out of your cyber insurance policy. Every cyber insurance policy today, for the most part, comes with kind of value added products to it, whether that's, whether they're going to do some external scanning for you, whether they're going to offer you EDR capabilities, email security, like get more from your cyber insurance product than just the coverage, and demand it. And if you have a carrier who's not giving you more, go ask your broker to find someone who is, because we, the insurance world, we want you to have those. There's a reason why we're giving you those value added products. It's because it reduces your risk, right? Yeah. And you do not want to have an incident particularly for small businesses, the sad nature of the truth for small businesses, if you have a cyber incident, there's a really high probability of insolvency, right? Because if you just slow down your cash flow grinds to a halt for a month or two, you creep up into insolvency. And the other thing I would add to it is, for the financially minded folks on the line, think of it as a line of credit. A line of credit, you guys are all paying for it. You have a line of credit. I don't know what you're paying right now, 7, 8, 9%, depending on the size of your business and your cash flow. But the cyber insurance policy translates to about 20, 30 basis points. So you're paying about 20, 30 basis points for a line of credit on what's probably the most likely cause of you needing financial assistance in your time of need, right? What causes financial hardship for a small business? The economy, essentially, product evolution. Your product is no longer, necessary because of the technological evolution, whatever it is. And likely the biggest factor, or the last factor, would be a cyber incident, right? So those are your biggest fears as an organization. So if you could have a credit facility out there that's just waiting to help you out when you have an incident. And by the way, the insurance policy, we parachute in the incident response process, all the experts help you restore, give you breach counsel, give you advice, give you the coverage that you need, give you the dollars to resume your business, get your backups back up and running, get you basically back to business. And I would just say it is a necessary buy for any single person listening to this podcast.
And you said it earlier. The insurance company has a vested interest in your success or your lack of failing at that point in time. That they are a business partner.
We are the most aligned stakeholder that you probably have in your business.
Yeah. Well, besides getting a cyber policy, which I absolutely.
Let me rephrase that. We're the most aligned vendor. If you want to think of us as a vendor, it's insurance, slightly different, but we're the most aligned with you.
No, that's a good point you made. And so besides getting a cyber insurance policy, which I absolutely advocate, what is the one thing that someone listening to this podcast today could do? Just one simple thing, one step in the right direction to improve their security and their operational resilience.
I'm not going to be able to resist. I can't just give you one. There's just
I know.
I'll give you one. I'll give you one, and then I'm going to give you some freebies.
All right. So it's a 1+. It's a tipping.
I'll give you the 1+, and because they're related, but a strong password policy. Keep use different passwords for separate accounts, use a password manager if you want to, but also enable MFA everywhere. I'll say that again. Enable MFA everywhere. Almost everywhere. And every single application that you use today probably has MFA. Go toggle it on. It's slightly more annoying. Get an authenticator. Don't use SMS if you don't want to. SMS is a little more annoying, I find, than an authenticator. Google Authenticator, that's a good one. It's free. Use MFA everywhere.
Yeah. Otherwise, it's a leaky boat, still has a leak.
Yeah, exactly right. Exactly right.
Gordon, it's absolutely a delight, and I should call you Professor Malin. But anyway, you always teach me something every time we talk. So thank you ever so much for your contribution to the Safe House Initiative. You've been a wonderful guest, and come back anytime because you're going to help a lot of people with this.
My pleasure, Jeff. Thank you for having me.
All right, thank you.
All right, take care.
That's our podcast for today. I'm Jeff Edwards for the Safe House Initiative. Thanks for joining us, and remember, be safe, be resilient, and be kind to each other. For more information about the Safe House Initiative, please use your mobile device to scan the QR code on the screen, or send us an email at info@safehouseinitiative.org, or visit us on our website, safehouseinitiative.org. We look forward to hearing from you.